Whenever people ask me about buying property as an investment, 90% of the time I'll advise not to do that. 10% of the time will agree if it's good value and if you can afford without overstretching yourself. But becoming a property tycoon is deeply ingrained in us, especially in Singapore. So you won't listen to my advice. Even my wife won't take my advice, so I don't expect you to. But then recently, DBS released a research report. Let me show you. The title is "Will Property Still Be Your Pot of Gold?" So DBS definitely has more credentials than me. So if you don't believe me, at least trust what they read. Maybe. Since this report is 50 pages long, and some sections are too much details, and actually I don't agree with some of the data. But this video I will summarize part of it for you. At the same time, I will share what I think about investments. The first key point they raise is that Singapore has this enduring love affair with property. And I think that is very, very true. Well, if you look at the past 30 years data, the compound annual growth rate is actually just 5.9% for HDB, 4.8% for condo, and then 4.1% for landed. So that's actually not a great return, because if you think about it, inflation, it will be around 2% already, and a lot of investments returns can even be higher than that. So let's take our old house, my parents' old house, for example. It is 35 years old, and the compound interest that I calculated is 6.8%. You can watch this video for more info. So that was the golden period. For the last 10 years, actually it has come down substantially. Another interesting data that they provided is this household sector net worth balance sheets. So this table is interesting. I actually copied and pasted and put it in my Excel so that I can see all this as a percentage. Let me show you. So this is the same Excel sheet. I said I'm not very interested in this 1995 and 2011. Let's just hide them. So let's compare just 2001 till now, which is a span of 20 years. So the key point that they raise is actually on this 42%, which means that in 2021, our property value to all our assets is actually 42%. And 20 years ago is 52%. So it is actually decreasing, which is actually good. That means our assets are less focused into just property. But as DBS said, that's why it's enduring love. What DBS thinks is that 42 is still a big percentage. If you look at then our financial assets, it would then mean that we have increased our financial assets much more. Basically, that means that we have more CPF, more insurance, and more cash, which means we are richer. Oh, one thing that is quite surprisingly is that the stress and securities have decreased. Does that mean that we are investing less in stocks? I beg to differ here. At the same time, I want to point out to you one caveat is that the source of all this data, they are from DBS and SingStack. Right now, if I want to recommend you the trading broker, I would say go sign up Tiger Brokers, because they give you one free Apple share that is actually worth like near 200 Sing dollars. So if you do sign up, please use my link. Other interesting stuff is really, I was looking at what they say about personal loans and mortgage loans. Actually, not too much changes, but you will see that our credit card loans increased by quite a bit, and there's also a lot of unknown loans. The next thing is that what is the key factors that drive property prices, and that one of it is our population growth, and that's not doing well, because if you look at the fertility rate, I'm sure you know, we have decreased until 1.1 and the replacement rate is 2.1, so we are that far off. Another way to increase our population is actually through immigration policies, but then here they pointed out that pro-immigration policies are limited by political and social considerations. That is totally right. That's why we say it's very hard to be PAP. They also pointed out comparing investments in the stock market versus property, be it their first property or second property. This is interesting, although I would say again, there's some caveat because they are using a 10 years data. So that's a bit unfair because, as they say, the last 10 years is not the golden year for property. On the other hand, the last 10 years has been a great year for the stock market, especially the US. They are now having the greatest bull run ever. That's why you see from 2009 till now, this S&P 500 shoots. And one of the things is that they put the rental yield in this calculation. The rental yield is 3% for all, which is not fair because the rental yield for HDB is definitely higher than the condo and landed. I myself can testify to that because earlier this year when we rent out our HDB, my parents' HDB, our rental yield I calculated is actually like 8%. So I would say HDB, if condo is 3%, then HDB should be at least 4%, and that will affect these numbers. But ignoring the S&P, even this local S-REITs is better at 4.8x. I personally agree because that's what I will advise my friends and my wife to buy. So the key is really to be diversifying. Don't buy your second and third property and overstretch yourself. I myself only have one primary residence, and then I will invest the rest in stocks, which can be further diversified by buying blue chips along with REITs, growth stock, US, China, anything else. So I fully agree with DBS that we should no longer play the property market as if we are still in the 90s. Stock market is a better investment, and you can start with as little money, but just remember to diversify your portfolio. If not, it is as risky as holding to one property. And if you are going to trade, please sign up with Tiger Brokers and get one free Apple share and let me earn a referral fee.